Good afternoon. Welcome to Chicago, Future of Finance. I'm Oliver Rennick. We are live from SIBO after getting snowed out pretty hard for a couple of days. There we are. Chicago winter definitely showing up with a bang. I got stuck for a couple of days in Arizona. It was nice, but it's good to be back. And it's also good to arrive with a VIX at 17. That's a pretty good situation. Equities are trying to hold on to a multi-day bounce. Information coming in the next 24 hours about services should probably be a pretty big deal. The market is starting to price in more cuts in December. Those odds have been moving up, and that's definitely a notable event. Looking at where we're at right now for the stock market, it's solid. S&P's back through into the high 60s right now, trying to get a real rally. Now, that being said, I'm a little bit hesitant to feel too confident about stocks to necessarily put the green light on the risk radar. I'm holding it yellow right now for equities despite the red on Bitcoin given the weakness in crypto. However, it is a good bounce back day for crypto. I think everything else in the risk radar has generally held into yellows for bonds and the dollar, though that story is going to get interesting. We'll talk about some of that with Nigam Arora joining us for a really interesting macro take later on in the show. We've got Brent Kochuba from SpotGamma joining to look at volatility right now. We've also got Scott Bauer and Pete Najarian in the mix. So this is going to be a packed show because it really is somewhat of a crunch time for markets. Going back to the chart again, you really want to see the S&P 500 get above 69 and then obviously push back to highs. I'm going to be a bit of a stickler on my risk radar and keep the yellow light until we get to new highs for the S&P 500. But the chart of coins with BTC is showing a little bit of life. You can see why it's still red though, because today's candle, even though it's solid, is still very much within the realm of the last couple weeks. And that tells us that there is a lingering malaise in the crypto world that we're going to have to shrug off. But whether or not that has broader impact, so far it seems like it hasn't. And that has been fairly encouraging, the fact that crypto has been weak, but stocks have been holding in. I want to also point out the semiconductors today up 2%. This comes back to the trade that I've routinely talked about here on the show, which is being long stocks, long risk of some form, and then also short crypto as your hedge. Once again, today will be a day where obviously if you're short in crypto, you're going to get hurt, but you're long stocks too. So if you can get the right dynamic between those two and the sizings, the long stocks and long semis part is a crucial element in this conversation. I do want to talk some volatility and talk some VIX, as I've got Brent Kochuba joining me from SpotGamma. Looking at the S&P 500 right now, Brent, it seems fairly encouraging that we are able to hold and get back to the levels from mid-November. Tell me if it's encouraging enough to you. Good to see you again, sir.
Hey, good to see you, Oliver. We're getting that winter weather over here, so I know what you went through. Look, in terms of the S&P, it's we're risk on now. Our pivot level is 67.75. We think over 6,800, you want to continue to lean to the bullish side. Last week, we had the holiday volatility crush, right? A lot of Vanna rally. We had that kind of time decay. Those ideas of Vanna and charm are intertwined. So that really propelled this market higher. We gained 5% last week. And now what it's about is waiting for data, right? We need 90% odds of a rate cut if you look at Kalshi, for example, or CME FedWatch. So traders are already pricing in that rate cut, right? And we have a little bit more economic data this week, PCE, there was JOLT data this morning, and obviously some delayed CPI data next week. So there's still a little bit of data coming out, but odds are we're going to get this rate cut. S&P's, I think, you lean bullish as long as we're above that key 6,800 level. We had poor CrowdStrike and Marvel reporting on the AI side or the semiconductor side. That story is strong. And Apple hit all-time highs today. That's not generally something you see in a bear market, right? Where things are kind of gross and challenging out there, right? So the big story here is I think you've got to continue leaning long, watching that right tail, which is just as important as that right tail at the moment. Once we pass FOMC, there's a little bit of vol that can continue to contract. If you look at 1 month realized vol, it's around 14. If you look at 5-day realized vol, it's like a 6 after this holiday week. So there's plenty of place or plenty of room for volatility to contract. And if volatility contracts as we start to go into the end of the year, Santa Claus rally really has to be on people's minds because you have the closures with obviously Christmas and New Year's and all that sort of stuff. So, that opportunity for volatility to still contract. And if you look at the 7,000 strike, there's over 300,000 contracts of open interest at that strike. That becomes the big magnet to the upside, the big round number that people are going to start watching. Oracle, obviously, next week. So there's a couple of data points still, but ultimately this remains to be the bulls have the baton, and you really have to give them a reason to lose in this case, right? We were talking about this recently, where it's like there's a lot of narratives out there, but narratives don't matter. We need an actual event to knock the bulls off the podium.
And that's because the numbers on the semiconductor and the AI trade are still strong enough, right, Brent? That's why they carry the baton. NVIDIA has been holding in. Like, the chart is not wonderful, but it's also not bad at all.
Right.
Think about like AMD that got pretty volatile as well. That's stabilized. It's not doing great, but even where there was some selling, it has stabilized. So I think NVIDIA, at 180 is a pretty regular area we've come up against, and we've found pretty good support there time and again. Here's that chart right now with NVIDIA at 180.
Yeah, you could easily see that chart. You look at that chart and go, okay, we're going to pop back up the 200 level. That's just as a likely scenario as a breakdown at this point. And again, you had a chance as a bear over the last couple of weeks to finish this thing off, and ultimately it just couldn't happen, right? Because there are these narratives around, but have year-end seasonality that's strong. We had that holiday time decay again last week. The earnings data coming out is not bad enough to knock these stocks off their off that podium/leading sector space. So at this point, it's kind of like, what is going to finish this thing off at the end of the year? We're going to get the rate cut now, 90% probability. We're getting clarity in terms of who the next Fed governor may or may not be, so markets can start to concentrate or on that. There's developments on the Russia-Ukraine front, right? So that could be another little sneaky positive that comes in here into year end. Who knows if that comes true? But at the end of the day, it's like how many, the bulls are running out of time. I think, the bears are running out of time. They bought a bunch of expensive puts last week. They paid the price for it, so they really want to take another swing into year-end seasonality here. I don't know if that makes a ton of sense. And do you see that term structure on your chart there?
Yeah.
That's really been sinking. Last week, we were near the highs of that teal cone or that shaded cone, that gray cone. So balls were pretty elevated. Now they're coming in. You mentioned that VIX is only about 17 right now. So there is space for vol to come down, and that's always going to be a tailwind for this market. It's going to help to prop that market up. Lastly, you mentioned crypto before. MicroStrategy yesterday looked like it was just going to get the finishing move, and now they kind of maybe bought themselves some time, and then the government saying that they may start to make some moves on, crypto policy and legislation that they've been a little bit behind on. So, there suddenly is like this safety net that comes out and maybe offering Bitcoin a little bit of a lifeline. And if you were going to build one bearish narrative, it was, hey, crypto's crashing, that could take out some of these big names in the MicroStrategy Coinbase realm. And now they're getting a little bit of a lifeline here too. So I just think that through attrition, the bulls may win, and we may finally get this final finishing move up to 7,000. That seems to be the way we're leaning, particularly if we're above this risk pivot of 6,775 to 6,800.
Okay, that's kind of it seems like the level I was kind of getting to as well, just from looking at the lines on the charts. My primitive approach seems like it's kind of, it's nice when it kind of lines up with where the math is, and it seems like there are some pretty clear levels that this market, if we do manage to punch through, and I think, I look at the high from November, roughly around 68, 60, and we're really close. 4 days with the chop here, but holding it without any momentum for bears to break it. I feel that if we get that 68, 60, that November high, then kind of to your point, this could be a 1 or 2 day thing, and we're making all-time highs again.
Yeah, very easy. I mean, 7,000
seems
away.
Like
a big. Yeah, it seems like a big number, but 1% is 60 handles now. We forget that, so it happens quick. You look on your chart there, you see 1 million contracts in Apple, nearly 1 million contracts in Intel, 1 million contracts in IBIT. Those are big volumes, right? Those are very big volumes, and they seem to be happening during an upside move, which implies call buying into this market here. So those are real volumes. That's money getting put to work. The other one that is showing up there is silver, which is really interesting at this point. Silver had an IV rank of nearly 100 with this stock up, vol up move, kind of asset up, commodity up, vol up move. We were actually pitching the idea of put flies this morning in our founder's note. Put flies would profit if silver corrects and vol comes down, which is kind of an interesting trade, looking at either end of December or January expirations there. That one asset is approaching very overbought, and you can see big volumes there as well, with 600,000. So, it's very hard. Again, you just look at the market leaders and they're not rolling over here. Again, Apple at nearing all-time highs. Those are just things you don't see right before we're about to have a giant capitulation at the downside.
Yeah. Later on, one of my guests joining me, Nigam Arora, is going to talk Alphabet. Since you mentioned it, Apple too. Alphabet was on my list as a unique breakout leader. But now Apple, and you've got the options volume to back it up, million contracts, and it's top ranking across the board, it seems like. And we like your daily gamma notional for Apple, is big, 1.1 billion. Only behind NVIDIA. Everything else is an index or a basket. So I think we like when the options traders and speculators are leading this market, right? Isn't that what this is all about? Like, isn't that getting that kind of gamma pull, that flow, that market maker pressure to just keep pushing that price higher like it is for Apple? And I'm going to pull up the chart here because, man, Apple chart looks like a beauty.
Yeah. That's exactly right. I think when you see a move just with stock volume and you see that stock volume is big into a move, people consider that move to maybe have a little more veracity, right? It's a little more truthful, as opposed to if you see a move on light volume with light positioning. And so in this case, you're getting kind of all-time highs. You're getting big gamma numbers, which tells us a lot of at the money or near the money contracts trading. Historically in Apple, what comes with that is a lot of actually call selling and put selling. Positive gamma flows oftentimes show up in these Apple moves, and that's oftentimes very supportive of that stock. So many people own Apple as just a long-term investment. They want to increase the yield on that. We've talked so many times about yield enhancement, how popular it is as a strategy now. And so selling calls and selling puts actually reduces the volatility. And what's interesting is if you look at Apple, it actually has a beta of less than the S&P. So it tends to actually move less than the S&P because it's just become this sort of, it's almost like a CD, right? You buy a CD, you get your 5% good. It's like an Apple. It's, for a lot of investors, it's kind of been the same thing. And so, there's just a lot of stability in that stock. And in this options volume, to me, in that name like Apple, talks to that stability. And look, if I'm a bear and I see Apple making all-time highs, I'm just thinking to myself, oh man, like I'm in trouble because, how do we roll over and have a violent crash from fresh all-time highs? It's just a rarity, right?
It seems like a low probability when Apple's as strong as it is, and it's backed by the options flows. 1.1 billion gamma notional, 1 million in options volume. And up there with NVIDIA, whose chart maybe isn't as compelling, but if the same options behavior is showing up in Apple as it is in NVIDIA, maybe there's hope for NVIDIA also to start rocking here. Great stuff, Brent. Pleasure to catch up with you. Appreciate it, man. Thank you very much.
Thanks so much, Oliver. Take care.
Absolutely. Founder at SpotGamma, of course, Mr. Brent Kochuba. Nice look there at the market overall. Going to take a short little break, come back for the gamble with Pete Najarian. Going to talk about Fed cuts, a little bit of policy effect on the market, obviously some trades in the options realm, but also some Super Bowl bets and the Bears, which have made now a pretty good little stand after people were doubting Caleb Williams. Seems like we're crushing it. So we'll do a little sports chat, a little event contract up next. Quick innovator buffer break.
We shall see.
With increased volatility.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. It's time for the gamble. Yo, Pete Najarian, how you doing, sir?
I'm doing great, man. I love the gamble. I'm ready for you, brother.
I love you. All right. There's a lot here, and the football I feel like is playing a big role there because I probably watched more games, both college basketball, NFL football, this past weekend with the fam and for Thanksgiving. We were mostly watching U of A football, though Arizona State was looking pretty decent for basketball. But I mean, we're back home in Chicago. Bears are kind of the story, Pete.
I'll tell you what, the Bears are absolutely the story, I think. I mean, obviously, New England has had what's been an absolute run, right? But I think the Bears, when you look at where they were last year, where they are this year, what's happening with the coach, new coach, obviously, and your quarterback, it's pretty amazing. And don't discount that defensive side of the football either. They're not the Bears of the past, but boy, do they cause a lot of turnovers. And when you can do that, you have a team that's going to probably have a lot of wins. It's just basically what we're seeing. I think they've won 9 of the last 10, and I'm pretty impressed with what they're doing. They still got 2 against the Packers to go, though, so those are going to be tough ones.
Right now, Kalshi 4% for them taking home the Super Bowl. What do you think? Is that fair, unfair? I mean, they got a lot of teams still ahead of them here looking at it right now.
Yeah, it's probably fair where they are right now because of the fact that if they don't get those turnovers on the defensive side, the defense has been run on, they've been thrown on. So, that's the one thing that I think has been an issue for them. And there's just an amazingly different year this year where you've got teams like Seattle and New England is back, and Buffalo, who everybody was so afraid of, now doesn't seem like somebody to be afraid of. So it's pretty interesting. But, as teams get healthier, that's when you really find out who's really going to be running all the way to the Super Bowl. So we'll see who's healthy in the last couple of weeks of the regular season.
You were talking Rams as a major contender, so it seems like they are sort of extending some of the lead here a little bit now at 17, but mostly just maybe due to others kind of dropping off per se. I mean, I know they've actually come up quite a bit. They were at 10% to start the month, so I think last we checked, they were probably below 10%. So it looks like LA is becoming a favorite.
Well, I think that quarterback is in line to be the MVP of the league right now. I mean, everything that they've done this year, they've done it in a classy way. They've done it in a very strong way. One week it's defense that wins, but every week that offense shows up. And when you've got Matthew Stafford back there and he's having a career year, they can be a pretty dangerous team to have to play.
Yeah. All right. Well, it seems like we should, I guess, start looking for Bears tickets. The price, unfortunately, going to be moving pretty directly with their success in that of Caleb Williams. So, but hey, it's nice to, I guess, get some confidence back in the great city of Chicago after much, awaiting and hopes and, having something here to latch onto. Let's talk the big picture. When I do think about markets and largely, one of the main reasons why, we are maybe rallying the past week. I don't want to put it all on this necessarily, Pete, but it does seem like there's something to be said for the Fed cut odds. Number of rate cuts in 2025 looking more like 3. and this has moved pretty substantially back above where it was in October. Tell me why you think that's happening and how important that is to the market firming up.
Sure. I think a lot of that has to do with the data that we've received. And when we received some of that data, the PPI and so forth, it just seems like that's almost a no-brainer. It's never for sure until it happens. But certainly we saw all the CME group and everything else start to really fly to the upside for the possibilities of that rate cut. And it's something, I think they needed to catch up, quite honestly, Oliver, to be honest with you. When you go back earlier in the year, there was quite a few times when the Fed came up there and expectations were looking for, hey, these guys need to have a cut, and they didn't do it. And so I think in some ways they kind of owe it to the market. And at this point in time, the numbers sure add up that we are going to see that cut. And I think that's what got the markets really started to get pretty excited, and people started jumping onto things. And I think that the Fed chair didn't put his foot in his mouth the way he sometimes does when it comes time after the previous Fed meetings. So I think it's pretty interesting how it's all playing out, and I'm expecting that cut. If we don't get that cut, I think the market's going to probably not be too happy about that in mid-December.
Yeah, this point, that correlation kind of seems like a real one. Again, as I've said before, it's not necessarily that we need a cut. It's that we, have no reason to hike. I think that's, an important difference is that. And people will argue, okay, do we really need to cut? I don't know, maybe we don't, but we don't need to hike, so then why wouldn't we just cut? That's kind of where I've come down on this. Now, the market still also thinks, according to Kalshi, an 18% chance that Powell's out as chair. Obviously, a lot of talk about Kevin Hassett. What do you think about how the market will handle potentially a new Fed? I feel like, to me, I don't know, that might be Trump kind of pushing a little bit of his luck with the market. I think a lot of people generally have liked Powell, even though there's criticism. I mean, look at what the market's done under him. Look at where we're at. How can we say this guy has done a poor job if we care about asset prices? Tell me what you think, Pete.
Yeah, well, I think I'd agree with everything you had to say. However, I would say that the president stands in a different pair of shoes than I do. And so
Sure.
I think under the circumstances that maybe the pressure has been there. He's been the Fed president for a while now. So, maybe it's his time to walk away. And, specifically when you look at what they've done, there's a couple other of the governors that are going to step down as well. So I think we're going to see a much different Fed when we get into 2026. That doesn't mean that necessarily it's going to be better or worse. I'm just saying we're going to see some changes. And with those changes, it's going to be interesting to see. And I think we all have to wait, because I think quite frankly, going into this year, if you would have said to me, hey, Pete, how many cuts are we going to get? I probably would have given you a number much higher than where we are right now. So it doesn't mean that he's wrong, but I do think that something the president's looking for is somebody who's going to probably be more aligned with the way he thinks the Fed should be acting.
One thing I will say is I've always kind of maintained that if you can pop the crypto bubble, which of course is injecting my own kind of cynical bias about the crypto market, where I think it's largely a monster bubble. If you can pop that bubble without hitting the rest of the stock market and traditional risk assets, I've always thought that would be like a nice magic trick from a policy standpoint. And I don't know, it kind of looks like maybe it's Michael Saylor doing the job of popping that bubble by just buying it all up and putting it in one kind of levered position. But to me, it seems like stocks are departing from the weakness in crypto, and I find that to be quite healthy.
Yeah, well, it seems that way. And I think the other thing is, Bitcoin obviously is a huge factor. I think when you look at Bitcoin, we almost always, everywhere I go, somebody says Bitcoin or AI, right? So I think with Bitcoin pulling back the way it has, I think the positive thing that I read about that is okay, that's happening to the folks that are going to be exposed to that. They're still a small, group, quite frankly. But if you go to the AI side of things, and everybody was talking about bubble, right? I mean, and that was the talk from everyone. Well, I think that the way people really tried to dissect that was wrong. They assumed that meant that anybody who has anything to do with AI is overpriced. I think that's a big false statement, quite frankly. I think the reality comes down to, if you've got AI, but you've also got, some of these companies that actually have a PE that's somewhere in the 20s or the 30s, that's a different ballgame. And I think everybody just kind of followed suit with each other and saying, well, AI is a bubble. Well, I don't think it's a bubble. And all you have to do is look at Mongo today and see what that thing was able to put up for their earnings. Their earnings were fantastic. They haven't really even scratched the side of anything to do with AI, but this is somebody that is going to be involved with AI, with the data side of things. And it's something that when you look at the numbers that they put up, they were absolutely spectacular last night.
Yeah, that's a great point. We're going to look at some MDB with my guest coming up. So hit me with a stock or an options thought, Pete. We hit sports, we hit macro, a little policy. Yep. What's action, what's active in your scan for stocks and your scan for options this week?
Sure. Well, just before I came on, I was listening to you guys, and you guys were talking about Apple, and lo and behold, we have some pretty interesting call buying we're seeing in Apple today. They're buying the December 287.50 calls. They're going out one more week, so they're going out to December 12th. They also 10,000 of those, 8,000 of the December 290 calls. So seeing that go across, that was pretty interesting for me. On top of that, we had NVIDIA, which everybody says, well, NVIDIA's, this, that, and the other. I'm not one of those people. I think NVIDIA still has a great opportunity to start moving back up to the upside along with some of the market moves that we're seeing. 7,500 of the January 190 calls were bought today. And lastly, I look over at FinTech and I look at SoFi. SoFi has some monster buying coming in there today. You look at a stock that's up 95% year to date. It's up 140% over the last 5 years. It's had an absolutely incredible run. And you've got somebody out there buying. They actually rolled a trade. They actually sold the 29 calls. They already made a lot of money on those, 28,000 of those, and still wanted to be there. Bought 28,000 of the December 31 calls for 80 cents. So really interesting to see that somebody not only wanted to be there, they didn't buy any extra time. They just wanted to still be in SoFi for anything else that might be there. And the stock is trading just above 30 last I looked. So it's got a shot in the next 9 days, something like that.
Looking at it right now, fighting for $30, trying to get back to recent highs of just below 31. Looks, again, like another pretty darn solid, maybe we don't have to have big breakouts like Apple, but at least to have those steady lines in the sand that have been driven for stocks like SoFi, for NVIDIA in particular, Alphabet to some extent, even though it pulled back a little bit, but really Apple just a hero. So good to see the call buying kind of lining up with what we saw from Brent Kochuba's data. Great stuff, Pete. Fun session. Appreciate you as always.
Thank you, Oliver. Appreciate it, man. Have a great one.
You got it. Likewise, Pete Najarian, co-founder at Market Rebellion. All right, short break. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Bang, there we go. Stocks looking like we're in pretty good shape. S&P 500 still holding in, even though we've pulled back. It's all right. We're still largely within the range of the session. Mid 6,800 right now. One of the big highlights, though, is a monster ramp and MongoDB after earnings. Software back, baby, if it ever went anywhere. Joining me, Nigam Arora is the founder at the Arora Report. Nigam, great to catch up with you again. Good timing with some action here in the market, trying to hold on to recent gains. How are you, sir?
Good, Oliver. How are you?
Pete was thinking the same thing. You were watching MDB just take off like a rocket ship. It's a pretty good chart. It's a pretty bold one. Tell me what you see and why this was such a blockbuster report.
Well, so several things. So first of all, I want to give some perspective. So we have something called a core model portfolio, and we've been holding MDB in this for a long time. We have now over 1,500% gain. I mean, that's easy to say, but it's nice to see. So they reported earnings. Earnings were much better than expected, but the earnings really do not justify the 23% move we're seeing. It went a little bit higher earlier and pulled back. So what's happening is there have been a lot of shorts in this stock, right? This is a database stock. The dominant player in database is Oracle. So the thinking was that Oracle has, done better and MDB is going to get hit. But that's not what happened. On every metric you can say, new customers and so on, they did well. And Oliver, you've been around, so you know what happens when a short squeeze happens, right?
So all those that's clearly there's a little added pressure on it today because of that, right?
So everybody was really short, Well,
who was down? Why were they down it? I mean, I know that this has been, of all the software companies, it has been a fairly volatile one. If we look at the 3-year chart, massive gaps volatile on this, right? So, and it's earnings based too. So it seems like the market has these moments of high confidence and then very low confidence, like in the earnings from the spring, that causes big sell-off down to almost 140. So this is the second or third quarter, really. Actually, maybe even fourth, because there's a big candle, right there as well in June. This thing always moves on earnings.
Yeah. So this is a classic stock which short sellers target before the earnings. Okay. Every quarter. And where you see on the left side of your chart there, a big red candle, and earnings don't come out, then short sellers press the pedal even more, right? So it goes down a lot more, you would think. And then if earnings are better than expected, then of course shorts have to cover, then you get short squeezes. So that's why, in the middle of the chart on the right-hand side today, you see those big candles. So that's the issue. So, where you're showing it dipped 100 and something, 150 something, we were buying there again. So the way you do it with this stock is, I think ultimately this stock is going to get bought out someday, not tomorrow, maybe a year from now, 2 years, who knows. And, it has a potential, it's 400 now, it has a potential to go to like 600, 700 even. But you don't buy it here, the risk is too much. So we have something called Aurora buy zones, and our buy zones are much, much lower. So you wait for a bad quarter when short sellers are pressing, then you buy it, and then you hold on. That's, I think, how you play the stock.
How much lower do you think, Nigam? When do you run to buy? Is it at that old level, 325?
No, I would, because next quarter, I tell you, if the earnings are not good, meaning even they miss slightly, the support that you see, and Oliver, I know you're so good about technicals and supports, the resistance, the support that you see in the chart, that's going to break. So you're going to come down quite a bit below that support. So that's where I would want to buy. I would be very patient. I would wait for the support to break that you're showing there.
So MDB cracks 325 and you just start piling money into this bad boy. Is that the message I'm hearing?
I think it starts getting close to 300 to 250. It trades in a very wide range. I would kind of start scaling in, I think, if that's what happens. If not, then, we have our core position. I think we're long, I have to double check, but I think we're long from like $24 or something. And we keep on holding our core position, And one other thing that I always look for as a kicker is, can a company like this being bought out? This is a kind of standalone database company. There aren't that many. And I'm an engineer, right? So I used to have a partnership with a company called Informix, another partnership with a company called Sybase, both for pure database companies, both got bought out. So the pure database companies get bought out. So One of the things we've done at Arora Report for our members is buyouts. So think about it. To date, 217, that's 217 of our portfolio companies have been bought out. That's a lot,
Yeah.
right?
You
And
think
I
that kind of
expect,
puts a floor under it? How low can it go
yeah, that
before
puts a floor, and you
somebody's
buy and you
interested?
hold on sooner or later, So I think I expect MDB is going to be bought out. I don't know. I can't tell you when it's going to be bought out, but I think it will be bought out. So the way you do that is the way we have done it, right? We have core position from $24 or something. We're sitting on a 100% gain. We don't touch it. We leave it alone. And then if it comes down, as I said, 250 to 305 or somewhere in that range, somewhere because they're bad earnings, we'll start buying it again as what we call the trader-on position.
Okay.
And the trader-on position, then the next earnings, when there's a short squeeze, we sell into it.
Okay.
So,
Got
that's why
it.
we're taking advantage of short-term and long-term both at the same time.
What else from the kind of juicy world of AI adjacent trades? I just pulled up the quantum ETF, which is kind of, it's a good fund in terms of capturing what it wants to, but it also kind of mutes the swing of the underlying companies that are big in the quantum space. Nigam, where do you stand on that theme, on that sector right now?
So I think quantum has a potential to be very, very big. The thing that most investors don't realize that quantum is not just one technology, okay? There are several different technologies in the quantum that are being used, okay? The dominant is superconducting, but there are ions and so on and so on. There are like 6 or 7, 8 different technologies. Mm-hmm. And right now, we don't even know which technology is going to be dominant, right? And I don't like this particular ETF, quantum ETF, because it has a lot of stuff that makes no sense to me.
Hey, it's 33% on the year, though. Can't hate that.
I know.
Can't
So
hate that.
I think in the quantum, if you want to play it, you got to own, like 3 or 4, 5 different companies, smaller positions. And if you can pull out a chart of something like RGTI.
Okay, Rigetti.
Rigetti.
Mm-hmm. You like buying this dip down here?
Not yet.
Really?
We may buy it if it goes a little bit lower. Now, the thing is, we own it from just before the rise started. Okay, we sold some not at the 59.60, but we sold some around I think $49.50, $49, $50. Still holding the remaining. So the same concept, right? You hold small positions for a very long time, and every time it comes down. Now, what I would do on this quantum one, you see the chart, you see the support. If it breaks the support, now see, I play somewhat differently, right? Everybody waits for support to when the support breaks, they sell it. That's where the stops are, right? But if you have good, this is a thematic company, and if the fundamentals are okay, and you really want to buy it, then what I do actually is I wait for the support to break because I know everybody's stops are right below that, right? Okay. So those stops hit, there's more selling pressure, short sellers come in, they push it down more, and then you buy it, right? So that's kind of how I like to play with quantum.
Okay. Fair enough. I know you like stocks.
I do.
You like individual companies. I'm going to give a tiny bit of love to quantum, though, just for a second, because I'm just kind of looking at the holdings in there, and you get a pretty good representation, I think.
You do.
It's just some of these are kind of, it's a different mentality, right? Going for the basket versus trying to pick the stocks. I know you like the higher octane game of, hitting the stocks, but I don't hate the basket approach for this category because I don't know which one of these are going to make it through and which ones are too much hype.
So here's the thing. So let's say I'm playing the AI game, right? So we have one service we call ZeroX allocation, which is only ETFs, and very popular among investment advisors because they don't want to deal with individual stocks; they just want ETFs, right? Mm-hmm. So we have ETF called AIQ, Apple Ida Queen, AIQ, right? That has done well. Now, I look at his holdings, and I look at it, 70-80% of his holding I would buy as individual stocks. So I love it, right? The problem with this quantum thing is it has all the things like, Oracle, I thought I just cited. Oracle is not big in quantum at all, right? It's a huge stock, but it's there. So this is not going to capture the upside move. When I look at it, if something really big breakthroughs happen and so on, this ETF is not going to capture that.
Okay.
So it's just not structured properly.
No, it looks a lot like QTUM, yeah. They look very similar.
Yeah. So, I mean, I often think about all these things. I say, I should go in the ETF business because I can structure a much better quantum ETF.
Sure. All right. Well, hey, I mean, to each their own. It's free market, baby. Give us the Arora ETF.
There you go.
Hey, Nigam, close this out real quick on a macro thought before I bring in Scott Bauer to talk some more about the big picture stuff here ahead of economic data tomorrow. I know you're watching the Japanese yen. Obviously, that's a close trade next to the dollar. You're essentially trading the dollar, given how much impact that has. But obviously not entirely. Japan's kind of got its own situation. And I feel like a week ago there was a lot of panic around their economy and kind of the narrative about what sort of interest rate pressure they've been able to handle or not. But I look at this chart and I think, maybe there's potential. I mean, I don't know, Nigam, you give me the take. It just bounced off a year-to-date low. To me, it's hard for me to want to short the dollar much further, but I could see an argument maybe that this last couple months of dollar strength could be prepared to fade a little bit. Give me a quick 60-second thought on your currencies.
Yeah, so I think in the long term, yen is undervalued by as much as 20%. But in the short term, you're right. I wouldn't short it. I wouldn't buy it. We do have a position in yen, kind of a long-term position. We kind of hold it. I wouldn't do anything, but I would keep an eye on it and the JGBs, right? Yields and JGB yields, because there's almost $1 trillion in carry trade, and a lot of that has gone to AI trade now, not just buying fixed income in the United States. So if the JGB yields rise much further, I think carry trade could blow up. And if it blows up, we got 10, 15, 20% down in the AI trade. So I think that's where I would look at.
Okay, interesting. All right, so maybe some currency volatility potentially on the way. Looking and waiting to buy dips in your favorite tech companies. Great to catch up, Nigam. Thanks a lot, as always.
Okay, nice to catch up, Oliver.
Fun conversation. Nigam Arora, founder of the Arora Report. Always a good mind on tech and more. We're going to talk about some of the macro themes and the big picture going into tomorrow. We'll take a look at the risk radar with Scott Bauer, joining me, Prosper Trading Academy CEO, here on the floor of SIBO. ISM Services tomorrow could be an important session. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago Future of Finance. I'm Oliver Rennick. We are going into the closing bell here. Few moments left, and it's looking pretty decent. Mr. Scott Bauer, CEO, Prosper Trading Academy, here with me on the floor.
How are you?
Pretty good, sir.
It's been a minute. Yeah, some good trade today. You know, it was midday when we had that little bit of a sell-off and we ticked into the red. I know a lot of people that I was talking to, a lot of the traders down here were thinking, all right, here we go again. We're, going to kind of back off. But, things sustained itself. I'm a little concerned, quite frankly, that maybe the market is expecting too much out of the Fed. Right? I mean, it's 90% now that they're going to cut next week, but then what? Right? Then what? If the Fed is really divided, if it's a 7-5 vote, an 8-4 vote, that's not good for the markets. So we need to see more conviction out of the Fed that, yes, there is the real majority of the FOMC voting members behind this rate cut. If not, I think that throws in a lot of question of what we may see going forward.
We went pretty far up in terms of the Fed odds the last couple sessions. Where do you think that mostly came from, Scott? I'm pulling up Kalshi right now, Fed decision December. It's one we've been going to all day. Obviously, it's a pretty big jump there. We're at now 92% that cut 25. So do you think this is reflecting, to your point, more consensus building?
I think it's reflecting that there is a deep concern about the labor market. What was it last week, 10 days ago, whatever it was, when we were down to 35% possibility only of a cut. And then all of a sudden, some of the data started to come out, and the data not being so great. Now, I know since then, we've got some retail sales data, which quite frankly has been mixed. I know everybody's talking about that, record online sales and record spending, but when you take a deeper dive into it, a lot of that record spending is because prices are higher. So I think there is some concern there by the Fed that we've got to get ahead of this, even though they may already be behind this.
Right.
I think they're anticipating that as more and more data comes out that we haven't seen over the last couple months, that it's going to reflect some weakening.
I do think that that's where I've settled on the debate, which is basically, if you don't have a clear reason to hike, why not cut?
Yeah.
To me, I've spent a good bit of time trying to, be the smartest guy in the, in the room. Everybody tries to figure out.
You've done a pretty good job of that.
Well, it's hit or miss.
Yeah.
But I think I've kind of boiled down to the point where the economic impact on rates is unless we really need to push to kill a really powerful inflation, then why not let things loosen up a little bit? And I think that even though there's some of that price stickiness, it's 3.5%. It's not perfect, but at least we're pretty far off, still way off from the highs.
Oh yeah, for sure. But I think one of the reasons why there is still some dissension there is because of that inflation number, right?
Yeah, the nominal number is still high.
There's no question. So if we don't start seeing the market or things being chipped away at, if that number doesn't start edging its way down a little bit, then I think further cuts are probably going to be off the table for the near term, regardless of how weak the labor market may be or some of the other data that comes in. If the inflationary pressures are still, if we're still seeing 2.8, 2.9, somewhere close to 3%, that to me is going to be a problem for the markets in terms of thinking where rates are going to be throughout 2026 and beyond.
I'm going to pull up the schedule for the next couple days here. It's ISM, the highlight, right? I mean, services seems like this number could be a big deal. The manufacturing kind of just always hits below 50.
Yeah.
But the fact they're expecting 52 for this tomorrow, after a period in which we got no economic data for the shutdown period, if these numbers start to roll in okay, I mean, that's a pretty nice dose, too, that I don't think necessarily means that the Fed can't cut. It's just that, you know, again, the economy's solid enough. We can get a little bit of both. It's kind of got its own life.
How is the market going to interpret that, though, right? Let's say it does come in at 52 or 51.8, somewhere like that, which is a decent number, right? We should be happy with that. Is the market going to accept that as good news is good news, right? We're moving along here. We're not contracting any longer, or is the market going to look at that as potentially inflationary? We don't know. I mean, there's been so many different data points that has really come out where I've thought the market would move one way, and we're seeing the market go the other way just because of the way that it is interpreted. So, you know, being in the blackout period now with the Fed obviously adds a little more, you know, secrecy behind what to expect next week. But these data points are big ones, and I think for the market to remain in this range that we're at right now, you know, somewhat near the top. Big sell-off didn't happen, but for the market really to remain here, we need to see these data points come in really as expected and not have an outlier.
No big surprises. You just don't want surprises.
Exactly.
Industrial production is supposed to be basically flat tomorrow. I think that kind of goes to some of the manufacturing conversation that just shows how focused this economy is on the tech, on the services side. But we do get jobless claims, and then we do get inflation on Friday. I mean, this is going to be a pretty busy week here in a way that we have not had a real kind of macroeconomic data week in a while.
Months. It's been months. So the balance of this week going into the latter half of the week can really set up next week. And I think there's also some bill auctions, if I'm not mistaken, Thursday, Friday. So, you know, we'll see how the Treasury market reacts to that. You know, this 10-year being kind of that 4% is really the target. And I know we were up to 4.10 yesterday. I'm not sure where we're sitting right now. I think we were down a few bips today, but you know,
10 years at 408 right now.
So, you know, if we look at that's a really interesting chart. I don't know if you can go back to that there for a second. Really, really interesting chart here of look at that over the last 6 months or so. You know, since May or so. Boy, if this rally that we just saw up to 410 here, if you're looking at that chart right there, you can expect maybe the next move down not only below 4, but dipping down towards that bottom edge there, 395 or so.
What I'm thinking,
which
is this year. Well, this was the trend.
I mean, look at that.
What a trend line.
I mean, that is.
This was the violation the last month.
That is the violation.
And now it looks like the trend is pulling. It's trying to pull it back down.
It is.
Look at the way it bounced, by the way, off just my kind of like ho hum randomly drew it line.
I mean, that is as pure of a trend line as you get. Yes, it did just break, but it looks like it may be setting up to retest those lows again.
It's an interesting idea, so maybe buy bonds. I think probably if there's one thing I've been most wrong about on my risk radar, maybe it's bonds because I've had them yellow. But the thing is, I also just haven't really been that, I don't know, I guess interested by it, the bond situation for the most part. But it's definitely obviously, you know, in an uptrend in price, downtrend in yield when you stretch it back. Anything beyond the last couple of months. But that's also kind of why they had a yellow. And
for sure. A little bit cautionary. And you know, who knows what we're going to see out of Japan, right? I mean, it was a week, 10 days ago, and it's still out there, but all the talk was what's going to happen with the carry trade? What's going to happen with this risk here? That seems to have ebbed a little bit, at least in volatility for the markets, especially for the equity markets here. But the expectation are that they're going to raise rates now. How is the market going to interpret that?
We were talking Japanese yen a little bit with Nigam too there in the last block. I'll bring up that chart for a second. The future. It's also is just taking a pummeling, obviously.
Yeah.
But I think there's a lot of focus on Japan in a way that, I don't know, I guess has stuck with us since the yen freak out. What was that last year?
Yeah, I agree. And you know, when you look at it now and see their 2-year, their 10-year at rates that we haven't seen actually many people haven't seen in their lifetimes, really. But but for sure in the last few decades here, that is definitely some cause for concern out there. As people may think that carry trade unwinds and people want to start, getting 3% yield in Japan and get rid of what they have here in the U.S. So definitely have to keep an eye on that.
Starts to get a little bit more compelling, I think, basically at these, at these levels when it's, gotten to where it is. Along those lines, I mean, gold today a little bit weak, but it sprung back pretty quickly in the last month. Where do you stand on gold versus silver right now? I'll pull up SLV, which looks like it's more the star child at this particular moment.
It is the star child, and from the emotional, psychological side of things, SLV is almost at the point now when other asset classes, Bitcoin or some of the meme stocks, got so out of line and was the craze that your Uber driver would start talking about it, that the person at the checkout counter would start talking about it, which again, from that psychological side of things, pretty much that called tops in those asset classes. We're getting pretty frothy here in silver. It's made up a lot of ground.
Another 1.25, by the way, percent.
It's made up a lot of ground from that gold-silver ratio that we saw so out of whack for so long. It's made up a lot of ground.
Point.
So I think moving forward in the next few months, I'm not saying silver doesn't have more room to run. I actually like gold over silver and for that ratio to widen back out a bit.
Looking at those two next to each other, obviously gold has petered out here a little bit while silver made this big move the last couple months. To relate it back to the economic data, I feel like it wouldn't be a terrible situation then if the numbers came in firm for something like silver, which kind of has a little bit more of that kind of industrial side. I think the bottom line is the next 3 days are very uniquely economic in nature, like we haven't had in a while. I know there's still some earnings coming through. They're important, but we kind of got through the big one, which is NVIDIA. Vol really collapsed around NVIDIA. We're back to normal VIX. So then my next question is essentially, how stable is the economy? Because if it's stable, I think we're looking pretty good.
If it's stable, I think we're looking great because I think the market is looking at it as there's some questions there. And that if the data actually comes out and supports that, things are looking pretty good here, that could be a big run to the for the market to get back to new highs because there is a big contingent out there not hoping for bad news but expecting really weak news. And if that has turned, boy, it could be off to the races here because overall earnings pretty good. NVIDIA was actually great. I think NVIDIA
I thought the numbers were good
was
too.
Phenomenal. Their guidance was great.
By the way, you nailed the fade of the vol trade.
Oh my God, that was
good
huge.
Trade. And by the way, really important too, because what that said is we got this anxiety out of our system.
That's right.
It could have easily been one that people had an impossibly high bar for, but instead vol collapsed.
Yep, and not that happens all the time, but when you understand the condition of volatility and you understand that mean reversion, right? And when people have all this built up energy and built up expectations, once that news is behind, as long as it's not catastrophic news, typically we do see that vol coming right back into line. And boy, it happened in a big, quick way.
That was a good play for NVIDIA. It's held 180. What are we missing here as we go into the bell? Any last thoughts for MicroStrategy? Hope spring eternal, or is this thing still in the muck? BTC, you impressed, Scott?
Why are you asking me about MicroStrategy? You have had the crystal ball for 9 months. I'm a little concerned about BTC 95, which would be another 3-4% or so. That's a big number. If you bring up volume trends and so some of the big area of consolidation, the 95 level is going to prove to be a big one that I think, to sustain any of this rally, we're going to have to see Bitcoin cross 95.
Yeah. All right. Well, right now it's able to crash basically the last month without phasing stocks, and I feel like that's pretty good.
I do too. I think the narrative has changed with Bitcoin and crypto in general over the last several months. But you're right. For Bitcoin to be down 30%, let's call it 35, whatever the number is, and the markets to be still trading near all-time highs, good sign.
Yeah. S&P 500, 68.29 at the close. Of VIX below 17.
This is a great day for the market. Why do I say it's a great day for the market? Not because we're in the green at the end of the day, but because we just have a moderate day here. No outlier, right? S&Ps are up
sub 17.
S&Ps are up 13. The VIX is back down, like you said, to 17. A VIX of 16 is a 1% daily move in the S&P. That's kind of the longer term average here. So, you know what? We want to see some of this normalcy. We want to see a little bit of not complacency, but maybe a little bit of consolidation here going into what could be a big run for stocks going into the end of the year.
Calm. We got calm back.
It's a good thing.
Great stuff. Mr. Scott Bauer, CEO of Prosper Trading Academy. Integral part of the show. Thanks for closing us out.
Really appreciate being back down on the floor.
Good to see you back on the floor.
Yes. Sure.
You're going to be here again this week.
Yes.
Charlie Moon as well. And then next week, baby.
Next week.
We're in Vegas.
Let's call it. Let's
Prosper
do it.
Trading Academy plus Chicago Future of Finance going back out west. All right. Thank you, Scott. We got to jump over time. Solid day for stocks. We held into it. Thanks for watching Chicago Future of Finance.